A bond is a large loan. Here is a contract to borrow money. There are some key elements to this contract that I want to go over. The first is the face amount. The face amount in this case is $10,000. That means that when you buy this bond, you are lending your money to the issuer of this bond, and regardless of how much money you lend, you will be paid back the face amount. This particular bond pays 8% interest, and it pays interest semi-annually. That means 2 times per year. So while interest will be $800 per year, it will be broken up into 2 payments per year. The term of this bond is 5 years. That means that the face amount will be paid back in 5 years. And during those 5 years, there will be 2 interest payments per year. That means there will be a total of 2 times 5, or 10 interest payments. Every interest payment is $400, and along with the last or the 10th interest payment, the issuer of this bond will pay the face amount. So the last payment is $10,400. Now in this video, I want to show you the journal entries to account for this bond under 6 different scenarios. The first 3 scenarios, we're going to issue this bond on January 1. And in the last 3 scenarios, we'll issue this bond sometime during the year. And that complicates things just a little bit because we will need a year-end adjustment for accrued interest in the last 3 scenarios. In this first scenario, we're going to borrow money. We're going to issue a bond for $10,000. Now, in the real world, it wouldn't be just 10,000. It would be 10 million or a much bigger number. But I'm just using small numbers so that we can easily see the math. So we're going to debit cash on January 1, and we're going to credit bonds payable. We always credit bonds payable for the face amount of the bond. 6 months later, we have to make our first interest payment. That will be 4% every 6 months. We will debit interest expense and credit cash. Every 6 months, we will do the same thing. We have to make 10 interest payments over 5 years. That's 2 payments per year. So the accounting just repeats every 6 months until the last payment. The last payment will be the last interest payment, but it will also include the face amount. So the last payment will be a credit to cash, $10,400. Scenario number 2. We're still going to issue the bond on January 1. But this time, when we issue the bond, we're going to receive more than the face amount. That means that some people are so anxious to loan us money that they're willing to give us more money than we are going to pay them back. So we're going to receive $10,500, and we're going to owe them $10,000 in 5 years. We'll debit cash for the amount we receive, $10,500, and we'll credit bonds payable always for the face. And to make this journal entry balance, we will credit $500 to an account called bond premium. Now, that bond premium account is going to have to be removed from the books over the next 5 years. And we're going to remove it from the books using the straight line method. And that's a lot like depreciating equipment using the straight line depreciation method. The first interest payment will be 6 months later, and we will debit interest expense for $400, and we'll credit cash for $400. Now, every time we make an entry to interest expense, we're going to take the opportunity to amortize some of this bond premium. So we want to take this bond premium off the books. It's a credit balance. We want to slowly remove it from the books over 5 years. That means we want to amortize this over 60 months. 5 years is 60 months, and 6 months have passed, so 6/60ths of this $500 will be amortized. That means $50. And since bond premium is a credit balance, let's debit bond premium for $50 to reduce that balance a little bit. Every time we amortize a premium or a discount, which I'll explain later, it will be an adjustment of the interest expense account. So as we're debiting bond premium, we're going to then credit interest expense. Now this is a pattern that will follow every 6 months. So if you understand so far, well, it doesn't get any harder. You just repeat that every time you have an interest payment. The only difference will be the very last interest payment will include the face amount that you will pay back. Note that when we issued the bond, we received $10,500, but we pay back just the face amount. In our third scenario, we're going to issue the bond again on January 1st, but this time we're going to only receive $9,400, and we will have to pay back the face amount of $10,000. So we will debit cash for $9,400. We will credit bonds payable always for the face amount, and we will plug the difference of $600 to an account named bond discount. Now, over the life of this bond, 5 years, we're going to slowly and systematically amortize that bond discount and remove it from our books. Every time we make an interest payment, we will avail ourselves of the opportunity to also make an adjustment of the interest expense account by amortizing a little of that bond discount and changing the interest expense account. 6 months later, we pay interest. We debit interest expense and we credit cash. Also on this date, we will amortize the bond discount. We will amortize this discount over 5 years, which is 60 months. And so we will amortize 6/60ths or 1/10 of this, and that's $60. The bond discount is a debit balance, so we have to credit bond discount for 60, and the debit will be to interest expense because the amortization of discounts and premiums is an adjustment of the interest expense account. Now, these two journal entries will form a pattern that will repeat every 6 months. The only difference is the very last payment will include the face amount of the bond. Now, the next 3 scenarios will be just a little different because we're going to issue the bond not on January 1. And that means that we're going to have a December 31st adjustment for accrued interest. Well, let's start at the beginning. In this first example, we will issue the bonds at face again, but we're going to issue them on March 1st. 6 months later, it's going to be August 31st. We will pay our $400 of interest. Every 6 months, we will be paying $400. After August 31st, the next interest payment date is February 28th. But before that interest payment date, we have year end, which means we have to make an adjustment for accrued interest. How many months have passed since August 31st? So we have September, October, November, December. We have 4 months that have passed. And so we need to make an adjustment showing that we have incurred 4 months of interest and we owe 4 months of interest, even though we're not going to actually pay that interest until the end of February. So that amounts to $267 of accrued interest. We will debit interest expense and credit interest payable. Then 2 more months will pass before we have to make our semi-annual interest payment of $400. we need to recognize 2 more months of interest expense. That would be $133. We need to remove the interest payable balance off of our books. So we'll debit interest payable and we'll credit cash of $400. Now this forms a pattern that will repeat over the life of this bond. It doesn't get any harder than this. If you understand this pattern, it just repeats. The only difference is the very last payment will include the face amount. Here's our fifth scenario. We're going to issue this bond on March 1st, but this time we're going to issue it at a premium. That means we're going to receive more money than we have to pay back. We'll debit cash for $10,500. We'll credit bonds payable always for the face amount, and we'll plug a credit of $500 to make this journal entry balance. Whenever we have to plug a credit, we call that a bond premium. We're going to amortize this bond premium off the books over the next 5 years. When is the next interest payment? 6 months later. August 31st, we'll debit interest expense and credit cash for $400. On this same date, we want to amortize some of that bond premium. We're going to amortize this bond premium over 60 months. 6 months have just passed, so we will amortize 6/60ths of this $500, which amounts to $50. We will debit bond premium to reduce the balance, and we will credit interest expense because every time we amortize a premium or a discount, it affects the interest expense account. Now, even though the next interest payment isn't until February, the end of February, on December 31st, which is our year end, we have to make a year end adjustment to show accrued interest and also to amortize a little bit more of that bond premium. So on December 31st, we will debit interest expense for 4 months of interest and credit interest payable, but we're also going to amortize 4 months of bond premium. We will debit bond premium and credit interest expense for 4/60ths of the $500 premium, so $33. Here is our last and sixth scenario. We're going to borrow money by issuing a bond on March 1st. This time we're going to receive less cash than we have to pay back. We're going to debit cash for $9,400. We're going to credit bonds payable always for the face amount of $10,000. We will plug the difference as a debit, and that is going to be debited to the bond discount account. We will have to amortize that bond discount over the next 5 years. The first interest payment is 6 months later, August 31st. We will debit interest expense for 6 months of interest, and we will credit cash. The next interest payment isn't until February, the end of February. However, before that next interest payment, we have year end on December 31st. So we have to recognize accrued interest for 4 months. We will debit interest expense for $267. We will credit interest payable for $267. And also at this time, we will amortize 4 months of the bond discount. 4/60ths of this discount is $40. So the bond discount is a debit balance. We have to credit bond discount to reduce that balance, and we will debit interest expense.